Thank you so much for tuning in to World is One News, and thanks again for joining us on WION Wallet, and welcome back. Now, humans created computers and a creation that can fill gaps where human beings are bound to err. The trading world has been using computers to buy and sell stocks at a speed that is impossible for making millions of dollars in nanoseconds. Today, we'll be introducing you to the world of algorithm trading.
Imagine a system that allows you to replicate the portfolio of Warren Buffett and make trades 100 times of that size in just seconds. Yes, you'll be making a lot of money in a jiffy. Welcome to the world of algorithm trading. Simply put, an algorithm is a set of instructions or rules. You instruct your computer program on what trades you wish to make and their quantity. After that, the machine does its magic and trading happens. The parameters of these rules can vary depending on the person designing the computer program. They can be based on timing, price, quantity, social media updates, industry reports, or any other mathematical model. The differentiating factor for algo trade is that the speed and frequency with which a computer program earns is way beyond human capability. What's more, such trades are usually executed at best possible prices, instantly and accurately. Transaction costs are minimized and the risk of human error is significantly reduced. The defining factor of algo trading is high-frequency trading across multiple markets, fully playing on arbitrage. But there are certain risks involved as well. For instance, system failures, network connectivity issues, time lags between placing an order and its execution, and worst of all, an imperfect algorithm. A trader once lost almost 60% of his portfolio due to a small typo in his computer program. So do know that algo trading can make you loads of money, but it can be tricky. Bureau Report, WION.
Now, individually, algorithms may be easy to control, but when they interact, they can create unexpected behaviors. The financial markets have crashed in the past due to algorithm trading. Let's have a look at some of these events. This year now, in October, the pound fell by 6%, with analysts pointing to the rogue computer trade as the possible causes. In May this year, also the China index futures suddenly dropped by 10% and then recovering all their losses in the same minute. Last year in August, about $1.2 trillion of market value was erased from the US shares before prices leveled again. On the 15th of October 2014, the US Treasury yields plunged and rose again due to rapid buying and selling. In April in the year 2013, there was a massive sell-off of the US stock futures even before the US market opened, but it recovered within the first few minutes of trading. On May 6, 2010, one of the biggest crashes were observed in the history of trading due to algorithm trading. The Dow Jones Industrial Average inexplicably experienced a series of drops that came to be known as the flash crash, at one point shedding some 573 points in a span of 5 minutes. We're now joined by a financial expert, Chirag Anand, to talk further about this computer-simulated trade. Good evening, Mr. Anand, and thank you so much for joining us on WION Wallet today. Now, it is often said that markets are governed on sentiments. Do these algorithms factor in this sentiment or make markets less susceptible to sentiments? What is your sense?
So, so sentiment analysis, as it's known in the trading world, it's one of the different, various strategies which are available, which people employ. So, there are technical analysis, there is fundamental analysis, and there are some quantitative methods which people use. So, sentiment, if we look at this particular strategy, or if we look at how algorithmic trading happens, so a person who trades on sentiment analysis is the same person who will write an algorithm for it, right? So when the same person writes an algorithm, he puts down his own thinking into the algorithm itself. So in that sense, the same strategy can also be deployed without algorithms, right? So there is not much of a difference if you specifically talk about sentiment analysis, that algorithms do, and what humans do, because it's the same human who is writing this algorithm.
Right, and does algorithm trading distort the share prices as well?
A lot of studies have been conducted worldwide and in India, which seem to suggest that algorithmic trading does not distort the market prices. In fact, because of algorithmic trading, the price efficiency has increased. What it means is that prices factor in the information much more efficiently and faster than before.
Have you also seen some sort of manipulation that takes place using the power of algorithms? I mean, one algorithm running on the stock market may not have much of an impact, but several algorithms at the same time can overwhelm the markets and lead to a flash crash as well. Are there any kind of regulations governing this in place in India and globally as well?
See, manipulation, if we talk specifically, it was happening even before algorithmic trading, right? And again, because if you have a malified intent, your intent is to manipulate the market, you can either write it into an algorithm which will eventually trade for you, or you can do it yourself, right? So algorithms by themselves, do not define the intent, right? It is the intent of the trader. And coming to multiple algorithms running at the same time. So, by multiple algorithms running at the same time in the same market, again, do not by themselves cause any distortion of the price or manipulation. What happens is that they do have an effect, like a correlation, what we call as a correlation, that for example, one person, if you talk about regular trading, I am watching the prices of a particular stock, and I see that the prices are falling. Now I know that there is some information available which I do not have, so I also sell. So algorithms work in a similar fashion. They watch how the markets are working, how the prices are moving, and then this is how they respond to this particular information.
Right.
Now it is possible that because of one particular algorithm, all the other algorithms behave in a certain way.
Right.
And as far as the regulations are concerned, there are no specific regulations which which deal with multiple algorithms running at the same times, but there are regulations which prevent market from going up or below a specific threshold in a particular time span.
Can you also give us a sense of how the flash crashes actually really happen? I mean, we've all watched a lot of movies on that front, but we've never really realized how these flash crashes do really take place.
So with flash crash, there could be multiple triggers for them. As I just said, that algorithms or even human traders, everybody is looking for information in the market. Everybody is looking for prices and trends, right? So if there is a trigger that price of a particular share or the index is falling or rising rapidly, then all the algorithms or all the traders, they react to it, and because of this, it creates a chain of reactions, and because of that, you see a sharp rise or fall in the prices in a short span of time.
And which are the markets in the world really that have maximum algorithm trading, and are there any on the Indian markets as well?
So worldwide, if you look at the developed economies like the US and the European markets, they have somewhere around 60 to 70%, more than that, in fact, of the trading happens by algorithms. And this is the same case in India, which wherein we have somewhere around 65 to 75% of the trading which happens in India is also by algorithms.
All right, thank you so much, Chirag Anand, for joining us live with all those updates. Really a pleasure having you on the show today. Well, that's all for now on this edition of WION Wallet. For more news and updates, check out our digital, our mobile and social media platforms as well. Thanks for watching WION Wallet. We will see you on Monday morning, 9:30 a.m. Take care. Have a great weekend.